Good evening. This is Rahul Magan here as a Group Chief Executive Officer, Treasury Consulting. As we speak, Treasury Consulting is a multi-asset and multinational hedge fund. By multi-asset, I mean we actively covering variety of asset classes. By multinational, I mean we cover multiple locations. But I did repeat it many a times. And I would continue to repeat all the times that we are a proprietary hedge fund. By proprietary, I mean no third party. Let me repeat, no third party can invest capital in our funds. 31st December 2021. I told you 2022 would be very volatile. And you witnessed that how volatile was 2022. 31st December 2022, I told you that 23, would be many times volatile we are having 2022. And we are witnessing that. You take any market, whether this is Indian market, whether this is US market, European market, any market, you will feel that the level of volatility is unprecedented. But unfortunately, many investors still not even bother to upgrade their knowledge. And they are still playing with the trump cards. Please go ahead. Now, when we take positions in equity market, now whether this is India, United States, Europe, Australia, any equity market, we need to understand that the best instrument to hedge the volatility, to play with the volatility, is Strangle. Strangle is nothing but a strategy which plays with the volatility. Strangle is of two types. You have a long strangle, you have a short strangle. Now, long strangle means you would be buying the call and you would be buying the put, which means either side you are paying to the exchange, which is known as premium. It means outflow is 100%. Short strangle, it is sell the call, it is sell the put, which means either side you would be receiving. Now, when we speak about long strangle, it means the loss is limited because you paid premium and max to max your premium would be zero. When we speak about short strangle, it means that the loss is unlimited because God forbid if the market goes reverse, you are gone. But having said that, let me cover the long strangle today and short strangle in some other video. In the long strangle, you would be taking a buy call and you would be taking a buy put. Now, when you are taking a buy call, you are holding a view that market would move up. Because when the market would be moving up, you would be gaining. When you are taking a buy put, you are holding a view that market would go down. Now, in this eventuality, it effectively meant that you are thinking market will down. Now, either of that would happen. Either the market would go up or the market would go down and you hedged yourself, which is called strangle. Now, the very important thing which we need to understand when we are learning strangle is the implied volatility. That's very important. Guys, please note that whatever index you are taking, suppose you are taking Indian index, US index, European index, or any index you are taking, in this eventuality, implied volatility of that index is majority of the times available on the Google. Majority of the times available on the Google. And remember that when the implied volatility is high, time to sell. When the implied volatility is low, time to buy. But please, this is not a hard and fast rule. There is a reason to it. The reason is that in the countries like India, the manipulation is always there. Not a single day is passed when there is not a news of manipulation. Rather, in a given day, you will feel like a loss making company who reporting huge losses on year basis, the stock is going up, while a profitable company who reports year and year profit and they are declaring dividends also, the stock is going down. This is fairly possible in India. Henceforth, this cannot be a benchmark that when implied volatility is high, then you are supposed to sell, or when the implied volatility is low, you are supposed to buy. At least in the country like India, this can never be a benchmark. Please to understand that how you would get to know that market is pricing something and market is do not pricing something. When we are using a word pricing, it means that something is cooking up. We all know that in the countries like India, foreign institutional investors, always been very active, whether this is index futures, whether this is index options, whether this is the cash trades, whether this is, you just name it, and they are active in almost everything. In this eventuality, if a strangle is priced at a lower side, then it is a red flag. Now, why did I use the word red flag? It's a red flag because, on Friday, I priced strangle at the money, which means at the money call, at the money put. And you would be very surprised that the total value of that strangle single lot is around 8,000 rupees. Around 8,000 rupees. And I was like, what the hell? The market is in panic. The Federal Reserve is hiking the rates. RBI hiked the rate. Adani issue not yet resolved. The institutional investors are selling in India. And there are hell lot of factors which we are having. But still, at the money, strangle is merely 8,000 rupees. How can that possible? But before I continue, let me tell you one beauty. Also, that if you are thinking that in strangle, the call and put are supposed to have the same strike price, then please stop reading the books, because this is theoretical. In theory, the call and put, whether you are long the strangle, whether you are short the strangle, they are of the same, strike price. This is theory. But the practicality is they may or might not have the same strike price. There are many eventualities which we are having in the market when the market gives us the better price when we have two different strike price. On the contrary, if we are taking a single strike price, we are not getting the better price. Henceforth, please don't just go with the notion that if it is written in a book, it means you can't change. No. Option is an art. It is not a science, remember. It's an art, and in an art, the more knowledgeable, the more envisaged the artist is, the better it would be. This is what I can say. But yes, one thing is sure, that The time ahead is highly volatile. There is no difference about that. The time ahead would be bringing some news which we may not like it. The time ahead would have high implied volatility. In this eventuality, strangle or the seagull, I say seagull, both long and short, would be the effective strategy to hedge your exposures. But let's see how this shapes up. This is Rahul Magan from Treasury Consulting Group. Can you my personal number +91 9899 242 978. Let me repeat +91 9899 242 978. Thank you.